Hi, I'm James. Welcome to Sketching Finance, where we simplify finance through visual storytelling. Welcome to a historical turning point in modern finance. The era of valuation based purely on balance sheets and steady cash flows is officially over. Look at the stalled $22.8 billion deal for the Panama Canal ports. Institutional investors like BlackRock are discovering that strategic infrastructure is no longer just a facility. It has become a geopolitical weapon. In the old world, we looked at earnings and cash flows to determine value. In the new world, a port's EBITDA doesn't matter as much as the color of the flag of its owner. When an asset is classified as a weapon, its strategic value to a nation's defense outweighs its quarterly earnings. As a financial analyst in New York, I can confirm that the right to own is now more important than the margin of profit. The White House now rejects foreign control over key choke points, citing national security. Border risk has officially surpassed market risk as the ultimate threat to your portfolio. For decades, the discounted cash flow, or DCF model, was our gold standard. We assumed stable cash flows for 30 years because infrastructure was a natural monopoly. But today, a single executive order or a treasury sanction can drop that cash flow to zero instantly. The assumption of long-term stability is dead. Investors must now shift to probability-weighted scenario valuation. We must factor in the mathematical probability of an asset being frozen or seized. In strategic choke points like Panama, this risk is no longer negligible. It is now estimated as high as 15 to 20%. We are now adding a geopolitical risk premium of 200 to 500 basis points to our required returns. If a project uses unfriendly technology or lacks defense compatibility, its value is discounted by at least 30% due to the extreme risk of zero liquidity. We are shifting from an era of maximum efficiency to absolute security. The old just-in-time model, which minimized inventory to free up cash, is being replaced by just-in-case and friend-shoring. This shift creates a permanent erosion of profit margins. We call this the resilience premium, the high price you pay to ensure your factory never stops. Increased inventory carrying costs and insurance alone can slash net income by 2 to 3% immediately. Germany is the prime example. After two Tepki benefiting from supplying machinery to China, they now face record trade deficits and a 14% drop in manufacturing. They have moved from seeing China as a buyer to seeing them as a systemic rival. Fragmentation leads to a massive CAPEX trap. Tech giants must now build parallel systems, one for the West and one for the BRICS Plus bloc. This double manufacturing increases fixed costs by up to 50% without increasing the total customer base. We are losing the economies of scale that made the last 30 years so profitable. Companies now face diseconomies of scale. Microsoft and Google must navigate data sovereignty laws, building separate, expensive data centers in restricted regions just to stay in the game. Western goods are becoming premium security products, often costing 15 to 25% more than the budget utility goods produced within the BRICS Plus ecosystem. This gap is a permanent fragmentation tax on global consumers. If you're finding value in this video, please consider subscribing. It helps me create more content like this for you. As the US and China undergo a trade divorce, hundreds of billions in FDI are seeking new buffer nations. Mexico is the direct beneficiary of near-shoring, becoming the new North American factory. Indonesia is leveraging its massive nickel reserves to force investors to build locally. Meanwhile, Vietnam and India act as safety valves for electronics and heavy industry. These regions command a premium valuation because their geopolitical risk is significantly lower. The Fed is facing a nightmare, stagflation. Interest rates are a brake for demand, but they cannot fix cost-push inflation caused by structural breaks and trade taxes. High interest rate cannot make imported goods cheaper when tariffs are rising. We are entering the era of fiscal policy and economic diplomacy. A currency's strength will now be decided by a nation's access to strategic resources like lithium and semiconductors through the CHIPS Act or IRA, rather than just its interest rates. With U.S. unemployment hitting 4.6%, the Fed is trapped. If they keep raising rates to fight trade-driven inflation, they risk killing businesses already struggling with high input costs, pushing unemployment even higher. In this environment, traditional 60-40 portfolios may fail as stocks and bonds drop together. You need a multi-asset fortress. Gold serves as geopolitical insurance when trust between nations collapses. Focus on companies with pricing power, those with gross margins over 40% that can pass tariff costs to loyal customers without losing them. If Apple raises prices by $100, fans still buy. A budget brand cannot do the same. TIPS, or Treasury Inflation-Protected Securities, are essential to shield your purchasing power from policy-driven inflation. Hard assets like oil and commodities also act as a natural hedge when supply chains fragment. If you fear a sudden tariff announcement over the weekend, learn to use tail risk hedging. Using put options for 1 to 2% of your portfolio can act as an insurance policy if the market crashes on Monday morning. Keep dry powder, cash in money market funds earning 5% interest. Cash is not just a shelter. It is an option to buy high-quality assets at a discount when policy-induced panics hit the market. We are moving away from a world where the Fed chair is the god of the economy. In the future, news about trade agreements, tariffs, and industrial subsidies will be the first thing investors must read every morning. Financial maturity means moving from maximum efficiency to sustainable security. Border risk is the new reality. Profit margins matter, but the right to own and access to resources are now everything. Build your portfolio in 3 layers. Layer 1 is growth, quality stocks with high pricing power. Layer 2 is defense, gold and tips to protect against inflation. Layer 3 is opportunity, cash to buy during panics. Subscribe to the channel and stay tuned as we navigate this era of uncertainty.